Hi, it's Jeffrey Cohen, Chicago Quantum, September 8th. It's Friday, 2023. So I haven't spoken to you in a while. Coming back, and I'm going to start with a video. Top 10 forces driving the U.S. stock market and what we're seeing out there. What the issues are. And so we're going to share this with you, and we're going to potentially talk through some of the data from our model. We've been running it a lot, run it last night, and I may even share some stocks that the model's been picking and kind of where we're at with that. So first this is found on our website, chicagoquantum.com/top 10. So the top 10 forces. The first one is short-term interest rates, flat, right? It's been in the Fed's policy range. The second is long-term interest rates have been rising, 4.25, almost 4.3. Wells Fargo Advisors is calling 3.5, and so long-term rates are higher than people expect them to be, and they've been rising, and so that either means recession or it means inflation expectations are rising, long-term inflation expectations. Because if inflation expectations, let's say, were 4%, you'd expect 1% real return on top of that. They'd be 5% for the 10 and the 30. They're not quite there yet. And so stock price variance. This is historical volatility 1 year. It is lower and declining further. So what that means is if you looked at all 3,017 stocks that we run in our model, and you look at the volatility of those stocks as a combined entity of 3,016 stocks, all held equally, fully diversified, you're at 4.27 times 10 to the negative fifth. That's lower. That continues to drop. So the market is seeing smaller gains, smaller losses, more kind of equilibrium. How does that compare? 4.3 compares to the S&P 500, which you guys know is formulated to be low variance, is 2.4. So 2.4 to 4.3, it's almost double the volatility, historic volatility in the overall market than there is in the S&P 500. This is the ETF. So that's interesting, right? So we see lower volatility and declining further for stocks. So why does it matter? If you know the expression risk and reward, or risk equals reward, well, if the risk goes down, the required reward goes down too, and so it's easier for people to put money in the stock market. Now the VIX is the market price for volatility that's low. It was rising, and then today it's fallen like a rock. Let's see if I have that up on a screen for you. The VIX right here. So this is a one-day chart of the VIX. And you can see that it is actually down almost 5% today. It was at 14 handles. It was like 14.25, 14.5. Now it's 13.72. And so if we look over the month, you see it had been falling along with historic volatility, and then it rose, and now it's falling again. And so these are pretty low levels. A 13.75 for the VIX is very low. And so, yeah, you're seeing stock price variance, historical stock price variance, market risk pricing lower. Makes sense? U.S. dollar has been rising aggressively since August 31st. This next one's a big one. Where's the momentum in the market? And so yesterday we saw that the stock market in those 3,016 or 3,015 or 20 stocks, the valuation fell $2.3 trillion yesterday. That's a huge decline. That's a lot of money. That's 4.5% drop in the price times the number of shares of all the stocks out there that are in our model. Now that's been rising, and so it fell yesterday. So the question was yesterday's close the peak? I don't think so because stocks seem to be going up today. But I don't know. Now, there could be some risk in the numbers. There could be some error. We get our data from Intrinio, which is a professional market data services company, and we use their field, their total equity market cap field. But assuming that there weren't any new errors from yesterday to today, then stocks fell $2.3 trillion in one day, and that's huge momentum in the negative. Government sales of debt for cash. Now, this one's interesting. There has been a reduction in liquidity. It's the opposite of quantitative easing. It's been quantitative tightening. So the federal government, both the Treasury and the Federal Reserve Bank, have been sucking liquidity out of the market to the tune of $100 billion, $103 billion over the last 2 weeks. Less money to trade for you and me. Energy prices. Oil and gas prices continue to rise. Natural gas is flat. Electricity, our data is a little dated. It's about a month old. U.S. consumers through the end of July spent 6% more in electricity than they did in June. That's a huge change. And it makes discretionary spending even harder to do when you have to keep the lights on, literally. Consumer theft and credit delinquency, only anecdotal data. Anecdotally, we're hearing that criminal theft from businesses on the rise. We've gotten data. We also hear that on credit delinquency, it's a little mixed. Some people say, yeah, we're doing great. People are paying their bills, no problem. No problem. Now, credit cards, problem. Maybe mortgages, a little bit of a problem, but in general, not a problem. And then other people are saying, look, there's a problem. We can't afford to pay the bills. You've got student loan debt. The interest is starting to come again, and people will be getting bills. So I don't know. That one is a wait and see. Labor cost increases, high and accelerating. Labor costs are increasing across the U.S. Headline levels of organized labor, as well as just the raw data. So Bureau of Labor Statistics, total comp is up 4.5% for the year ending in June. It's not a lot of money, though, in terms of like August wages were up 8 cents an hour. So in August, it slowed down. Now, if you look at the Q2 data, which is through June, hourly compensation was up 5.7% on average. If you look at just the hourly comp for manufacturing, it was up 8%. So 5.7% through June, that's very heavy inflation on the wage side, which is good for workers, but bad for businesses and bad for prices on things that we buy that are made with human labor. Inflation, finally. So Chairman Powell, the Fed Chairman Powell's favorite measurement is personal consumption expenditures, PCE, price index, excluding food and energy, or what they call core PCE. So if you were to do a Google search, Jeffrey, what's core PCE? Just do that, core PCE. You're going to see the data. You're going to see that it's up, that it was up 4.2% for the year. It's higher than the long-term average. And in July, though, it didn't go up very much, 0.2. But there's new data called the Nowcast, which is suggesting 0.4. Core PCE, actually around 0.33. And the core PCE will have risen 4% in August, 3.9% on an annual basis in September, and monthly gains of around 0.33% for both August and September. That's higher than the 0.2 that you see here. That's 0.33. And annual increase in core prices of 4.2 looks like it's going to stay that way. Now the headline consumer price index, now casted, the headline CPI number is 0.8. Ugh. That implies a 9 to 10% increase in August on an annualized basis of inflation. That's crazy. That's going to really scare people. And so that's what we saw in the market. So if we look, when these things go up, it's bad for the stock market. So short-term interest rates, flat. So that's 0 up. There's 10 of them. Let's see how many fingers I raise. Long-term interest rates rising. That's 1. Stock price variance is declining. Nope. US dollar rising. That's 2. Share price momentum. There's not really momentum, but it was a really bad day yesterday. Government sales of debt for cash. Yep, they took $100 billion out. That's 3. Energy prices are up. That's 4. Consumer theft and credit delinquency. Not sure. Labor cost increases. That's 5. Inflation. That's 6. So 6 of the 10 factors would lead for stock prices to go down. A couple of them just hard to tell. And the thing that's moving in the opposite direction is stock price variance, which is a little bit of a touchy-feely thing. So that's what we saw. That's our top 10 list. I'm just going to share some data from our runs just to show you kind of where we're at. And that's it. That's going to be the whole video. Hopefully you're going to enjoy this little bit. I'm not going to give you the actual stock picks, but that's okay. You don't need that yet. So as of September 7, we ran it at 842. So we gave it the market time to kind of clear. Expected market return on top of risk is 8.22%. There's a risk-free rate of return of 5.5. That's the 6-month yield. And you can see that the one index that doesn't even make its floor is the IWM or the Russell 2000, the small caps. So the small caps haven't really gone up all year. The S&P 500 recently kicked butt, up 15.25%. The NASDAQ is up 26.5%, has done great. Tech has been crazy. We talked about there's 3,016 stocks that made our list. The expected return, if you held all of those stocks evenly, including dividends, is 15.4%. That's great. Drop your money in that stock market because that's a really high expected return. The Chicago Quantum Net Score Power at 5.4 is also very, very bullish. And all stock variance has been dropping. So that's great. Now, if I show you the 10 best stocks picked in our model, you're probably going to have a heart attack, right? Affirm Holdings, a subprime lender. Open Door Technologies, Cardalytics, Digital Turbine, Invitae, which is a tiny cap, Compass Inc., I don't even know what they do, Redfin, I think that's the red boxes that you rent the videos. So, hey, Blockbuster's coming back. Skills, which is a gaming, player versus player. Carvana, which not only do they sell you the used car, but they hold the car loan. And the real, I have no idea what that is. So these are the stocks that the model really likes. This is crazy risky stuff out there. The market is saying that the risk is on. Earn 15% if you buy them all. These stocks have expected returns of like 25 to 30%. This is crazy. It's all this new economy stuff. Wayfair, Wish, Context Logic, Unity Software. So these are stocks that are new economy, they're gaming, they're digital modernization and digital monetization. Actually, 3 of them do that. Cardlytics, Digital Turbine, Unity. Now, Wayfair is monetizing. Skills is monetizing the work. Affirm is, again, subprime, buy now, pay later. So, crazy stuff out there. This is what the model likes. It tells me maybe now's not the time to be jumping into the most risky stuff, but this is where your edge is. And in fact, there's probably something I can talk about, and maybe I'll do a separate video about where is the edge. Now, one last thing. Chicago Quantum is the home of the negative beta stock list. These are the stocks that have a negative beta over the past year against the S&P 500. First off, it's a long list. Second off, there's a lot of biotech in there. That's weird. So biotech is moving opposite to the stock market, whether it's Summit Therapeutics, whether it's Calvista or Relmada. No idea what they do, by the way. I haven't done that kind of homework. I'm guessing that Cencora, Celine, Sedara, Cano Health, Acero, Adamas are all biotech. So biotech is moving contra to the market. Now, Fiserv is interesting because Fiserv is a tech company that serves financial services companies. So maybe the financial services companies have been cutting back. Chesapeake's a utility. U-Haul's always interesting because U-Haul is who you call when you get kicked out of your apartment or you got to move. And usually a U-Haul is when you do it yourself. So these are people maybe without a lot of money. And so when U-Haul is going up, when the market's going up, that says that real American people are suffering. Liberty Media, that's a specific case. They had fires and stuff. It's all kinds of stuff going on with Liberty Media. So I don't know that that's an overall market thing. But they do sell things, online and on TV. And then Sinclair and Sadat, I don't know. And Veru, I used to know. So a lot of negative beta. But negative beta is either biotech, which is counter-cyclical because the biotechs are just moving independently. U-Haul, which is a lower income folks. Fiserv, which is selling to the banks. There's a utility company, which you never know. And then there's just special cases. So I want to thank you for watching. If you found it useful, please do me a favor, hit the subscribe button and drop a comment. Maybe give me a thumbs up. That really helps. It makes me know that you want me to make these videos. And have a great day out there. I appreciate you taking the time to watch. Bye-bye. All right.